All right, so today we're going to be talking about factoring invoices. Factoring invoices. So I don't know how many of you, and I wish this was interactive. So I wish this was one of our actual interactive Zoom meetings. It would be awesome. I don't know how many of you are familiar with factoring invoices. So I'm going to just go through and give you some pointers regarding factoring invoices. So one of the things that is really important about, well, I'm going to go all the way back to actually introducing to you the particulars regarding factoring invoices. So first of all, why would someone want to factor their invoices? Well, here's why. One of the first reasons that a company would want to factor their invoices is for payroll purposes. Question number two, what exactly is invoice factoring? Well, invoice factoring is a method that's used by lenders to loan a business money based on the invoices that are due to them. And so what they'll do typically is they will run a business credit check on the corporation that owes you money. The corporation that you've done work for that owes you money, they'll do a business credit report on them to see what their paydex is. And then at that point, they'll determine based on the amount of money that's due to you from the invoices, how much money they will loan you. And specifically, a lot of companies factor invoices to pay payroll. It's a way to consistently make sure that your payroll is going to be paid. Okay. And the way that it works is that once you have signed an agreement with them, giving them the right to loan you a certain percentage of the amount of invoices that's due to you, they also have you to sign an authorization that the client will then have to agree to or disagree to. That client has to agree that they will pay that invoice. When they do pay it, they're going to pay it to the factoring company rather than paying it to you. They're going to pay it to the lender that loan you the money, that advance you the money, and they're only advancing you a percentage of the money, right? So when your client pays you the full amount of the money, then the lender that's factored your invoices keeps all of that invoice payment. So normally it's somewhere around 15 to 25% that they charge. Okay. But in some cases, it can be well worth it. I've seen cases where they charge as little as 5%. But in some cases, again, it can be well worth it. So let me break this open for you so you can understand exactly what I'm saying. I'm going to give you a scenario, and then I'll put something up on the screen to give you an idea of what I'm talking about. You want to make sure that you have an adequate amount of cash flow. Now, if you're a cash heavy company, your first thought is, I don't need to do that. But I want to respectfully differ with you, because if you're cash heavy, you need as much credible write-offs as possible. A credible write-off is the discounted amount between what your invoice payment should be and the amount that you're factoring. Does that make sense? So the interest that you pay or the rate differential that you pay for factoring can be written off. Matter of fact, a large percentage of it can be written off. So if you're cash heavy and prone to owe quite a bit of taxes because your net is still excessive to the point that 21% is going to be exorbitant, then you may want to consider, and a lot of the Fortune 500 companies, they do this because a large portion of it they can write off. They're not doing it because they need the cash. They're doing it because this is a way for them to prevent owing a lot of taxes, because this is largely a credible write-off. Okay, so listen up. If you're a cash heavy company, and what I mean by cash heavy, a lot of companies, abstracting companies, their expenses are very low. So their profit margin is great. Okay, they have an awesome profit margin. Okay, that means that they're cash heavy. So what happens is that a lot of that money, especially if they're doing business with the general public, because the general public is paying them directly and they're typically paying with cash most of the time. Okay. So with that, they're going to be cash heavy. If they're doing a lot of work for clients that are corporations and settlement companies, mortgage servicing companies like Old Republic, WFG, Service Link, then okay, those funds when you get paid, they're directly deposited into your account, but that's still cash. Your profit margin, you have very small profit margins. So, or should I say, you've got a profit margin of like 90%. So, got an awesome profit margin. There's some other companies that are cash heavy. Bonding companies are cash heavy. Matter of fact, they actually receive a lot of cash. And so companies like that, you want to make sure that you benefit from the very credible write-off that you get from factoring your invoices. Okay. But there's a way to do it, and you need to understand the strategy that you need to use. And of course, in our next edition of Easy Corporate Comprehensive Curriculum for New Business Owners, there will be an expanded version of this teaching in chapter 12. So chapter 12 already talks about budgeting, creating a percentage budget for operating your company. Yeah, for company expenses and other items and investments. But it's going to be expanded so that it gives more information regarding factoring invoices, because there's nothing in there regarding factoring invoices, because that first book was for new business owners. The next one is going to be for management services, and that is for existing businesses. Okay. All right. So when we talk about, again, factoring, we're talking about a financial arrangement whereby your company sells your accounts receivables. Those are unpaid invoices to a third party. And that third party is called a factoring firm. Okay. They give you immediate cash. So instead of you having to wait 30, 60, 90 days for the customers to pay, the business receives in advance, upfront, 90% sometimes of the invoice value. So if you're an abstracting company and you're waiting on your clients to pay you for your abstracts, and let's say they pay 30, 40, 60 days out, instead of you having to hold on to those invoices and figure out how to operate without the cash, you can factor your invoices. Okay. Yeah. And if you do closings and that's all you do, I definitely would suggest that you factor your invoices, because see, those companies that you're waiting to pay you, they will pay these factoring companies right away. Okay. All right. So they may take forever to pay you, but they'll pay the factoring companies right away. Now, here's the issue. The factoring company is only going to pay you up to 90% of the value of your invoice. Okay. Yeah. So, and they're going to collect that payment directly from the client that owes you. Mm-hmm. Yeah. All right. Want to make sure let's let that sink in. All right. So again, it provides immediate liquidity. That's the main thing. It's not a loan. So it doesn't create a debt. There's no collateral that's required outside of your invoices. Your invoices are the collateral, your unpaid invoices, your accounts receivables. Remember, I talked to you all about how vital your AR is. See, companies like this take a look at your AR and they determine right then whether they're going to factor your, go ahead and advance you your invoices and the percentage. But you got to have your AR together, and that should always be together. Yes. All right. Payroll is something that you have to pay. You can't put it off. You can't play games with it. You've got to pay it, and you've got to pay it at the time that it needs to be paid. That is why this is a wise idea for certain companies, depending on the type of clients that you have. If you've got A1 clients, again, in the abstracting business, you want to do this. Now, for Bell's bonding, like I said, it is a very lucrative business. However, factoring your invoices in some cases may or may not work. I've seen a lot of companies sell theirs a lot of bonding companies sell theirs to collection agencies, and they're able to collect a certain percentage of their accounts receivables. I, you know, hmm, factoring invoices would be excellent. The only thing that I think Bell's bonding companies would have to overcome a hurdle is that typically factoring companies want to collect directly from the entity or individuals that owe the money. So I don't, and they have to be considered credible. So I don't know how that would work out for, it'd be very lucrative to you. But those are some parameters that but there are some factoring companies that work just with Bell's bonding companies. That I do know. Okay. All right. So let me show you an example that I have here of what the flow chart would look like in factoring invoices. Let me pull it up on the screen. All right. So hopefully you guys can see that. that this information was beneficial to you, because invoice factoring can be an excellent way to keep your company's payroll consistent. Let's say we were dealing with a staffing company, because we have one of my clients that takes the course, their staffing company. So let's say they've got $100,000 in outstanding invoices, right? And they pay their staff biweekly. Okay. So that payroll that they have to meet is somewhere around $60,000. They're going to factor like $80,000 worth of invoices that's owed to them from clients. And they're going to factor it at an 85% advance rate. That means that the factoring company is going to pay them 85% of their payroll. And their payroll is $80,000. Excuse me, I'm sorry, not payroll. The amount of invoices or AR that they're going to be factoring is $80,000 worth of accounts receivables. Yeah, and the factoring company is going to pay them 85% of that up front. So they're going to receive $68,000 up front. That's enough money for them to cover their $60,000 payroll and have some change left over, right? So once their client that owes them that $80,000 in invoices, once they pay the factoring firm, then the factoring firm is going to deduct like another 2% fee from that. And they will typically return the remaining balance to you. They'll typically send it back to you. They're just going to take their fee. And you would think, well, I thought that the 15% that they withheld up front was their fee. No, that's not their fee, right? No. Their fee is going to be an additional. So they charge 15%, or I'm sorry, they pay 85% of that $80,000. That's $68,000. Payroll was $60,000. So you've got like $8,000 that you have left over in your account to work with, and you paid the payroll as well. Now, when your client pays that $80,000 to the factoring firm, again, the factoring firm is going to deduct an additional 2% because that's their fee. That's their factoring fee. Okay, an additional 2%. And then they return the remaining balance. All right, let's say they took over 90 days to pay that. Your client took over 90 days to pay it. Now that factoring fee may be a little more than 2%. Whatever the difference is, they will return the remaining balance to your company. This way, you know that your payroll is being paid on time, and you can consistently factor. Like, you don't have to, it's not a one-time thing. Once you sign an agreement with them, then they know consistently every 2 weeks you're going to be sending them a list of AR for them to factor. Okay. All right. So I'm going to stop right here, but there are a lot of companies that you would want to reach out to and talk to them about factoring invoices. Companies like Paycheck Funding Solutions, Riviera Finance, Triumphant Business Capital. A lot of these companies have been around for a long time. They, over the years, they've maybe changed hands, so they've changed names, but they're still the same companies that I know a couple of them are the same companies that we've dealt with decades ago. So same companies, they've just rearranged their company existence, and so the name of the firm has changed. All right, so hopefully this has been beneficial to you. I have gone over my time, but remember, this particular module is Easy Corporate Comprehensive Curriculum for New Business Owners, and specifically we're talking about factoring invoices. If you want to know more about this, I'll be more than happy to assist you. Reach out to me, and we can, in our class session, in your class session, I can specifically tailor a module just for you, and then we can do an exam on it as well, and that counts towards your certification. All right, guys, see ya.